Lane's here. The other day, this girl called me and she was a casting director from New York and they were making a new HGTV show about flippers or wholesalers. I talked to her on the phone and I told her what I did and she said that was pretty boring. And I was like, yeah, it's not really made for TV. You just buy these properties out of state. So yeah, that's pretty much going to be the closest I get to television. I'll keep doing these podcasts. So I've been getting a lot of questions from that Turnkey podcast, and there were 3 of you in particular that sent a whole bunch of questions. So 3 listeners can't be wrong. Today we got a few listener questions. Are you visiting these locations at any frequency and for the initial purchases, or are you able to have enough trust and working relationship with other professional resources at those locations? First of all, I have visited the teams in Birmingham and Atlanta, but that was probably about 1.5 years ago after I bought the first property. The people were real nice and it really was a legit business. I was really surprised, especially with Birmingham, that the houses were a lot more spread out and it seemed a lot more like a suburb. And these were even in the C+, B- areas. A lot different from Seattle or your normal, more populated cities. People always say that they need to go visit these locations and meet the team, but I really question if it's needed from a business perspective. You're going to spend about $1,000 on travel, hotel, food, and just if you have to take off time from work and doing something other than traveling to Birmingham, you're only going to get about $2,000 to $4,000 of cash flow a year out of each of these properties. So $1,000 is like burning up half of your cash flow. So it's not really worth it in my opinion. Unless you're that person who needs that warm and fuzzy feeling to go to bed at night and you're going to buy a bunch of them. But when you buy stocks or mutual funds, you don't go to New York and shake hands with the executives of the stock mutual fund folks, do you? Do you have any turnkey recommendations? So I get this question a lot, and when I do get it, that's all the question there is. And I'm like, really? Like, how lazy can you be? I know a lot of people are pretty busy, but there's also a lot of people who are just lazy and just wanting to get free answers from other people. Like I said before, this is a time for you guys to build a minimal level of competence through asking questions and trying to figure out what's what without getting the answer in the beginning. Another reason I don't like these questions are these are the questions asked by people who ask all these questions and never follow through themselves. Another thing is I don't want to be held liable for recommending a certain turnkey provider and turns out things change and they're not a very good one anymore. And the last thing is I don't really care about getting any kind of silly referral commission. That's why I made this podcast in the first place, because there are a whole bunch of random folks out there trying to seemingly help other buyers when really all they do is CC your name on an email to the turnkey provider and pick up like a $1,500 or $1,000. And I thought that was really messed up and they didn't really help you in a way. I need to narrow down my markets and look at the data. So I see this as a big excuse to dumpster dive in technical hell. There are about 8 markets out there that are good, robust economies, like not Detroit, and good rent-to-value ratios that support viable cash-flowing investments. And some of these listed out are like Chicago, Memphis, Indianapolis, Birmingham, Atlanta, the Carolinas, Jacksonville, Florida, Kansas City, Ohio. Dallas is cool, but it just lacks the cash flow because it's been going up in price and it's a lot more of an appreciation play. But I like it for apartment buildings. And then not Arizona and not Las Vegas. They're just too volatile. Other than these locations, why go out to anywhere else where there's not a proven team or a proven market that other people are going to? I always say stand on the shoulders of giants and value add after that point. You can nitpick the different markets, but in my opinion, I don't see much difference between, say, Birmingham and Atlanta. And we all know Birmingham has a lot more cash flow than Atlanta, and Atlanta is a lot more appreciation. But when I look at my spreadsheet, it's not more than, on average, $20 per month cash flow, with Atlanta being more of appreciation potential. I had a conversation with another investor the other day, and he was really into optimizing all the data from the best markets and really picking the best one or two. I was trying to get him to get over this hump of trying to analyze all the markets. And this is the response I get in your property management, is helping your kid pick the right friendships, which we all know is more important than what they wear. So I said, send your kid with some decent clothes and emphasize on picking the right friend. I don't have any kids, so really what do I know? But the point is, emphasize on finding the right team and getting the right trust in folks, and don't really spend too much time on which market you're going to go. There's all this data out there, and it's just ridiculous in terms of what are the key performance indicators in that data. I'm an industrial engineer, and I can build you one of those ANOVA tables and try to figure out what's the key performance indicator, but there's just really no way of doing it, and it's an art, not a science. Question number 4, tenant grade materials. I hear you mention this a lot. No garbage disposals, laminate floors. Can you please expand? Garbage disposals are the number one fix I see. Heck, I even had one in my own house. A little rock got stuck in there. It just didn't even cycle. And all you had to do is get rid of that rock. That could have potentially been a $100, $200 fix right there. So why even have them? The next one is laminate floors. This is something that all the cool kids are using these days. It's indestructible and it looks really cool, and you don't have to be changing it out every time you have a new tenant. That leads into carpet. I do not like carpet anywhere in the house, but it's just something that you have to just keep on replacing. These people are wearing shoes in the house. They are treating it like rentals, like when you guys have rental cars. Carpet is just, I would just stay. The garage door. A lot of us have garage doors that open up. I really don't see the point in that in a rental. It's just another thing to break. I did have one of my tenants ask for a garage door opener. There was already a garage door, so that expense was done, but they just wanted the opener, which was a few $100s. And I communicated that it just really wasn't going to raise the rent. And I said, if we're going to put this garage door opener in, are you guys going to pay much more rent to make up the difference? And I never heard anything after that. So I guess they didn't really want it. They really didn't want to put their wallet where their mouth was. Next thing is the washing machine and dishwasher. A lot of these things are market specific. I went to Birmingham and a lot of these people didn't have washing machines and dishwashers. These are the big ticket items that have a potential to break, and it's just the normal way in life in a lot of these towns is these people just go to the local laundromat and do their laundry that way. The number one goal is maximizing the rent. And I would use a general rule of thumb is that if you're not getting a 20% year-over-year return on your investment, or at least breaking even, I wouldn't really do any of these upgrades. For example, if that garage door opener was only $100 and the tenant was willing to bring up their rent $10 or $20 a month, yeah, I'd probably do it for them just to make them happy. But if they're not willing to open up their wallet and pay for a little bit, or at least split the difference, or pay half, then I'm not willing to make the change. Question number 5. I initially thought Indianapolis was where I was going to go, but wasn't comfortable with the responsiveness of the turnkey company, so I backed off. I just wanted to remind folks that these guys are primarily rehabbers, and it doesn't really mean that these guys are bad, that they're not getting back to you in a super timely fashion. Do you want to be paying for that extra bloat of someone who just does sales all day long? I wouldn't. Question number 6. Wow, the performance and rent-to-value ratios in Chicago and Florida are off the charts. Always do your detailed spreadsheet to account for all the costs and verify each line item. Chicago has 3 times the amount of taxes as all the other markets, and it's really anti-landlord state. And Florida has 2 times insurance because of all the hurricane potential there. Indy has a 2% investor tax. Overall, when you add these markets all together and you normalize all the nuances, it really normalizes all the markets. And to me, they're all the same. It's really the team in place that means more to your bottom line. Question number 7. You talk about buying turnkeys 3 ways: the marketer, hybrid with the agent, and direct from turnkey provider. What's the best? Depends on your situation. A green investor should go with a marketer or a mentor/agent. A more experienced investor can work directly with the turnkey provider. I have personally switched between direct and with an agent. Question number 8. Do you prefer to stay with newer homes, say 1990 or 2000 and newer, or are you okay with older homes from the 60s or 70s as long as they're in good condition and neighborhoods and have been rehabbed? I prefer newer because that means you will have a newer curb appeal. However, those come in with a bit of a higher price. I don't discriminate between older homes, granted that they are not functionally obsolete. You have some of these homes with this weird kitchen thing where it's like a hallway, and people just don't like these floor plans these days. They want the kitchen and the dining room to be in one big room. Renters, again, can't be choosy. There is something to be said about an older home that is time-tested and has got the kinks out, like a car. Don't forget about capital expenditures. I have heard that certain areas, like in the 1980s or 1985, that they've used superior materials than today and vice versa. Every market's different. You can't really pinpoint any certain time era. Maybe you can get something from an inspector and kind of piece together a story that way, but it's just too tough and it's not worth creating a thesis on it. Question number 9. How do you manage your out-of-state properties, by the way? What challenges are you facing? People think that this out-of-state stuff is the hardest thing in the world. It's all about managing via email and phone and keeping those people accountable. It's just no different than corporate America. Be firm, and your leverage is to fire them if they're not performing. I know that I pay markups all the time, and I probably could run it better myself. It's theory of no one will wax your car better than yourself. Too many people have this old school mentality that you need to live near their rental and do everything. Well, unfortunately, all these stupid money is around you and they're bidding other properties up, and that's the downside of doing that strategy. I urge those who want to be landlords and not investors to read the book E-Myth by Michael Gerber to open your eyes. So that's all the questions I had today. Now, I bought my first turnkey back in 2013. Today, with the prices going up and more stock refugees coming to the turnkey world, margins are just getting smaller and smaller. I stopped buying a few months ago, and I don't really plan to buy anymore for a while. My issue is that one big item goes out, like an HVAC. That guarantees that you're going to lose money just cash flow wise for that year. I'll review my article on the hidden ways you're making money with real estate. The cash flow is just the tip of the iceberg. Remember, there are other ways that you're making money, such as the mortgage pay down, appreciation, and the tax benefits. Even if you're not cash flowing anything, with turnkey investments, you're still probably getting at least 10 to 20% in the first few years of return. And this is greater than the 8 to 10% that we all hear about with stocks and mutual funds. So is that extra 10, 20% worth it to you? That's the question. I did not figure out how to do things until I got about 3 or 4 of these properties. Each time I overpaid by a few thousand on each one because I just did not know what the heck to do. You just don't know what you don't know. Remember the 70-20-10 rule, where 70% is doing, 20% is learned by peers and mentorships, and 10% is reading books and podcasts like this. My last piece of advice to leave you guys is when you're buying in this kind of seller's market, just be patient and know your numbers. I update a little heat chart outlining what I think the best markets are in terms of cash flow and appreciation, where I show the nuances between Birmingham has more cash flow and Atlanta has more appreciation play, and all the other markets. If you want that, email me a screenshot of your iTunes review. Thanks. Bye.